Welcome in, folks. Got a 7-piece for you here today. Oh, we got so much to get into in this one here today, folks. Okay, first one up here, I want to react to this little 3-minute clip. Economy grew at a faster pace in Q2 than people expected. Okay, this little 1-minute clip, pending home sales fall 5.5%. We'll react to that, kind of give my opinions and perspectives. Mad dash on Dollar General, which that stock is absolutely collapsing massively right now. Look at that stock, down 40% in the past year. Lululemon, want to react to that one there. And then we're going to cover NVIDIA. NVIDIA earnings were boring, but stock still has plenty of runway. I want to react to that one. It gives my opinion and perspectives there. NVIDIA faces challenges as promise of AI is ahead of results. I think that should be an interesting one to react to. And then last one, warning signs emerge in NVIDIA's earnings report. So looking forward to getting that one. Appreciate y'all joining me. As always, thank you so much for being here. Thank you for smashing that thumbs up button. And thank you for being subscribed to the channel. So look at this. We had needed one stock to die so the rest could live. We had a sacrifice, yes, and it was NVIDIA. NVIDIA is down 5% plus here today. Man, oh man, did you watch the last video I put out on this channel? What did I tell you guys? I said NVIDIA is not going to move anywhere remotely close to what Wall Street expects. I told you guys 4% to 7% will be the move. And it looks like it's going to end up being right in the middle of that 4% to 7%. Fascinating, right? PayPal's having a great day. Another big partnership Alex Chris announced here today. Massive for the company. SoFi's having a great day here today. This is just kind of looking at the big tech watch list. But if we pull up my stocks watch list here, well, this is like the stocks I own, right? A lot of good out there today. SoFi's having a great day, up nearly 10%. That one's back over $8 very nicely. PayPal having a great day. Planet doing decent. Palantir up very nice again here today, about 2.7%. Honest having a good day. Shopify, Tesla, Win. Not much to be read here today. Avant's a little red. Elf's a little red. Revolve's a little red. Elf is going through, and I talked about this a little bit in the main channel video last night. Elf is going through a very similar phenomenon right now to NVIDIA stock, actually. Those are two, obviously, premier companies, just two of the best stocks in the market for the past many, many years, right? And certainly the last 5 years. And those companies are just so, you know, everybody just expects so much for them. And if there's just anything that's seen as weakness, they just, you know, they can't wait to sell it. And so that's what's going on there. All right, guys, let's start jumping into these.
Initial jobless claims, continuing claims hitting the wire. 12 weeks in a row above 1.8 million. We'll do continuing claims first. 1,868,000, very close to expectations. Last week was subtly revised from 1.863 million to 1.855. As I said, 12 consecutive weeks. Initial claims, 231,000, very close to expectations, and that is 2,000 less than a slightly revised 233,000.
So far, is Wall Street going to like these numbers? The answer is absolutely. The thing that would worry Wall Street is if these were massively too hot or too cold. So meaning essentially if the number was really, really bad or really, really good. They want to see right around consensus because that means the Fed can kind of make their moves here in the short term that they want to make, right? Which is lowering rates, but not going too crazy with it. If you know, the jobs market was too hot, people would worry about inflation. If it was too cold, people would worry about recession. We kind of need that perfect kind of middle ground here.
If you continue to monitor these claims, it's been a while. 250,000 was the high watermark last week in July, and they have been on the low side since. In the 230s, we even had a 228. That was in the second week of August. And all these numbers, as Becky pointed out, continue to drive the notion that it's still a split decision on exactly how weak the labor market is getting. Now, let's turn towards GDP, a revision to the upside. Second quarter, second peak, moves from 2.8 on GDP to 3%. And just to put a face on that, the last quarter of 23 was 3.4. That's where we're comping to on the strength. Consumption also upgraded rather dramatically, 2.9% versus 2.3. 2.9 also comps the last quarter of 23 when it was 3.3. Price index moves up as well to 2.5 from 2.3, and that comps to the first quarter of this year when it was 3.1%. And finally, if we look at the core PCE index quarter over quarter. It's the only metric here that came in on the light side. 2.8 versus 2.9. And of course, the recent high water mark was 3.7 in the first quarter of this year. You see yields moving up on this data, whether it was initial claims or the rather strong revisions on the GDP. And I do point out the price index moved up. Core didn't, but it's still much closer to 3%. Real quickly, let's look at some other metrics out there. If we look at inventories, wholesale inventories built up 0.3 as expected. Retail inventories, however, much stronger, up 0.8%. And in the rearview mirror, we have 0.7. So nice strength building there. And last but not least, on the trade deficit, which is a trade balance, the balance is a deficit. This is well worse than we were expecting. Look at a number for minus 97, minus 98, minus 102, minus 102.7 billion. That is the worst level going back to May of 22, and it does underscore the notion that the rest of the world we need to pay very close attention to because, indeed, we are definitely consuming a lot more than we are exporting on that trade balance. Interest rates really popped up on that. We're at 3.86 in a 10-year. That's up about 3.5 basis points. A 2-year note yield, well, now it's at 388, but prior to that, it was...
So the issue with this GDP number here, the big issue, to be quite frank, is it just didn't feel like that when we looked at company earnings this earnings season, right? We had some decent, respectable earnings from some companies out there, no doubt. But as a whole, can I say it felt like a GDP, a real GDP of 2.5% or of 3%? I just... looking at this earnings season, it just doesn't feel like that, right? Which kind of goes back to, people feeling like these numbers are cooked and those sorts of things.
Right? The lowest level should have closed around 383, 384 since May of last year. Becky, lots of data, lots of market movement. Pre-opening equity futures are even doing better on this because there's nothing wrong with a little 50 or 60 growth.
Points. Yeah, or actually 35, 40 points maybe for the Dow. Rick, I was just going to say thank you for that Lollapalooza of information. Nobody does it better with getting that many numbers. My head's spinning just trying to follow the whole thing.
Alrighty, next one, pending home sales.
How's that for us? Hi, Diana.
Hey, Will. Yeah, pending home sales dropped 5.5% in July month to month, according to the realtors. That's a big miss. The street was looking for flat. Sales were 8.5% lower than July of last year. Now, these numbers are based on signed contracts during the month, so the best indicator of how buyers are reacting to current mortgage rates. And the average on the 30-year fixed actually dropped in July, falling below 7% for the first time since March. And it went all the way to 6.7%, which should have brought buyers in, but clearly didn't. The realtor's chief economist blamed it on affordability challenges and, quote, some degree of wait and see related to the upcoming U.S. presidential election. I think likely more...
From what I'm hearing from the home builders, it sounds like the end of July and into August has been very, very strong. So, I don't know. Don't be surprised if August ends up coming in as a much better number than whatever Wall Street anticipates here.
Was the former, and wait and see on interest rates. Regionally, sales fell the most in the Midwest, which is oddly where prices are the lowest, also in the South. But the South is where we see the most new home construction. We know the big builders are taking a big advantage over the existing home market because they're able to buy down mortgage rates. David?
Yeah, so once again, don't be surprised if all of a sudden, we see a beat in the month of August. Dollar General, what a crazy move down for this one here today. Looks like at 1000xstocks.com. Obviously, insanely low forward P, 2-year forward P on this stock, but do you want to own a dollar store is a big question, right? Do you want to own a dollar store? I don't know. I don't know if I really want to own a dollar store, but it is dang cheap. It is dang cheap. By the way, if you want access to 1000xstocks.com, as well as my private group, private stock group, private wealth group, all those sorts of things. I'll put that as pinned comment down there. You can click on that, fill in an application. We'll see if we can get you access next week.
0.5%. Traffic growth partially offset by lower average transaction amount. Consumables up 6%. Right. Seasonal down, home down, apparel down, and then we get to the guidance, which is why the stock is guidance. Wow, a quarter of its value being cut off.
Well, okay, so let's either talk about the disappointment that they see and the hard luck of the consumer. We know the consumers got stretched by inflation. Or Doug McMillan. David, Walmart has become a driving force where people who are of lower income recognize that the prices have come down and feel like they're getting the everyday low price that Sam Walton created. And that return to Sam Walton's roots, which is stellar what Doug McMillon is doing, is just rocking everybody.
So what do you do if you're a Dollar General and you're competing that with Walmart in a way, perhaps as you at least put it, that you haven't previously?
Right. Well, Todd Vestas, what does he have to do? He has to come up with some sort of loss leader, the way actually what Sam Walton used to do, that get people in, because all the categories that you said are weak are where all the gross margin is. So I cannot. Now, look, can this bounce? He's actually a loved guy, okay?
Yeah.
But if you look at the 3-year, David, this has been a loser. And the reason it's a loser has nothing to do with them. Walmart changed. Walmart decided to go after with a couple of $5 and under products, David. Meanwhile, Dollar General's products go up, Walmart's products go down. The Walmart stores are fantastic. They started to incentivize managers to be able to get it right for the areas they're in. It's a clinic, Walmart, and so is the stock price, as is Costco.
Yeah, new highs on Walmart. The guidance, let me just give people the guidance on Dollar General. Same-store sales guidance is now between 1 and 1.6%. Previously had been between 2 to 2.7%.
That's very big.
And fiscal year 24 EPS now 550 to 620 versus 680 to 755. So use 550 to 620. That's off of a stock price. Obviously, it's going to be the 90.
This is an elongated earnings season, and this is one of the biggest misses, and that's what happened. It's also used to have a reputation for never missing, and that's no longer the case. Dollar Tree actually has a better record now. But I just think that people have not been to the snobs on Wall Street have to go to several Walmarts to see the pricing, and they will be blown away. I mean, when we go to Walmart, my daughter's a baker. If you want cheap product to be able to make it so you can make cookies with a gross margin, you have no choice. You have to go to Walmart. It's really quite extraordinary.
All right. We're going to cover Best Buy, of course, earnings of which are sending that stock.
So Walmart, I obviously came from the retail world, and I want to explain something that's actually really important, because if Walmart's doing what Kramer's talking about here, it's actually genius. Giving their store managers a lot more, let's call it emphasis on merchandising, choosing certain products to get it right in their particular areas and those sorts of things. When I worked for Walgreens back in the day, and that was still in Walgreens' kind of like heyday of like a really well-run company, they kind of fell apart the past 10 years. But back then, Walgreens did a great job of incentivizing their managers to essentially have certain types of merchandise that might do well in that area. And they used to reserve massive amounts of their different shelving and whatnot that you could actually change the way you wanted to, so it didn't just have to be like everything that corporate sends you down. Certain things had to be the way corporate tells you, hey, this shelf has to be set this way, it has to be set this way, you got to have this certain product, it's got to be this much distance, all those sorts of things, right? The price is this. But for a certain amount of the store, you could actually merchandise that yourself, right? And it led to stores that were a lot more interesting back then, a lot more well-run, managers that were a lot more engaged, and even employees that were a lot more engaged, because my managers sometimes would let me like merchandise, even though I was like 18, 19 years old. They taught me how to merchandise shelves and how to kind of set the product up to look nice and whatnot, right? And what might sell good. And of course, me always being a value person, I always put something that was like a really good deal. I felt like something that was like 2 for $1 or something, and I'd put that sort of stuff on the shelf, right? And it was great to I used to feel energized as an employee, because I'd come in and I would see like, wow, we sold 2 of those, that's awesome. Like it was a great feeling. And that's how you give power back to your employee force, and ultimately how you end up producing better results overall, right? And obviously, if Walmart's going back to those sorts of roots, I think it's the best thing you could ever do as a company like that, right? And the more corporate, like it's all got to be this way. This is the way all our stores are done. I'm telling you, you're going to end up hurting your business over time. Like you really are. Like the store managers are smarter than I think a lot of people give them credit for. Next one up here, Lululemon.
For the fact that we have NVIDIA, I know.
What happened to Lulu?
I remember there's one store manager I had. His name was Mr. Anderson. Mr. Anderson. Oh man, he was phenomenal. So this guy, when it was like Halloween time, he used to go crazy with the store in terms of making this Walgreens look like just wild, in terms of the different inventory we'd have in, and coming in was like an experience. I'd never seen a Walgreens be an experience when you come in. After that man would decorate the store for Halloween on the inside, it was an experience. It was like cooler than going into like a spirit store or something like that, like way cooler. Like he would have it like these things hanging from the ceiling. It was crazy, man. I don't even know how to explain it. It was wild. But anyways, that's just, you know, you lose some of that luster over time when you go more corporate, and you can never get it back.
They had a botched launch of a particular kind of fabric that just didn't go well. David, we now have, I mean, everybody's been joining the Ray J, 400 to 350, okay? Well, I mean, it's 270. Cowan, 420 to 375. What you have here, David, is a new, we see this happen quite a bit. The analysts were so excited here that it's like, you know, you can't go, I'm going 540 to 270 because you'll look like a total dope unless there's a stock split. But I will tell you, David, this is a little anomalous. I'll give you a little anomalous prediction.
Please.
If they do in line, I think the stock goes up. They have $2 billion in cash. They could do a hefty buyback. Okay. I don't think that they're going to take this sitting down. I think that they're tired of this. They have done this before. They have said, okay, look, our inventories are lean and we're back. I think that if they just say, hey, we're where you think we are, then the short squeeze starts.
Interesting. Okay.
Yeah.
So all the bad news in some ways is
that's so you got something you got to worry about in regards to Lululemon. Okay, when you see a chart like that, you have something major to worry about. And I've been talking about this a little recently on this channel and on the main channel. What is it? It is tax loss harvesting in the fourth quarter. I mean, it's been a brutal year for a Lululemon shareholder. I mean, if you've bought Lululemon at any point really in the past year, you've lost not a little bit of money, but a lot of money on this stock. And so likely you've made profits on other stocks. Let's hope you made profits on other stocks, right? And so, maybe I want to pay less taxes. Okay, let me sell out of Lululemon, take a big loss there, write that off against my gains. Boom, 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 boom. Okay, beautiful.
David, they call it because they want to make a fancy term so that nobody at home understands. David, this is de-risked.
De-risked.
It's de-risked.
De-risked. The drawdown has occurred.
Yes. Oh my God! You private credit guy.
Drawdown. I still just.
So is it de-risked? I don't know about that, just to be quite frank, right? What happens if their revenues turn negative? That's something you have to consider at least as a potential. I don't know if it's really been de-risked that bad. Like, it could get worse. It could go 150. Like, I wouldn't bank on it going 150, but is it impossible? No. So if we compare Nike versus Lululemon, one of the things I love about 1000X is the compare feature here. We're going to see Nike trades at a trailing 12-month P at 21, Lulu's at 21. Forward P 26 on Nike versus 19 Lulu. 2-year forward P is around 18 for Nike, although I do believe Nike's going to emerge much more profitable than Wall Street expect here. But Lulu's at about 16, right? As far as next year earnings per share growth, about 29% expected for Nike, and I think that number's low, by the way. I think they're going to do better than that, but 29% Wall Street's expecting, about 30%. 13% for Lulu. Next year revenue growth, 9% for Nike versus about 13% for Lulu. So clearly, Wall Street is expecting there to be profitability and margin issues with Lululemon, right? Which is a scary dynamic because you don't know when that's going to end, right? In terms of margin compression. At the end of the day, if you expect your revenue to go up about 13% and your earnings per share to go up about 13%, like, you're not getting any like lift on your business. Like, naturally, if let's say your revenue is up 13%, you should see your earnings per share grow 15%, 17%, 20%, something like that. Especially for a company that's a little more mature now at this point in time, like a Lululemon. You don't want to see like the same number. Otherwise, what are you doing all this for? You need to see it. You need to be beating, when it comes to earnings per share, it needs to be ahead of wherever your revenue growth is. So that shows there's some sort of real systemic likely problem with Lululemon's business model that has to be addressed. Alrighty, let's start diving into NVIDIA earnings. We're boring, but stock still has plenty of runway.
To build out AI infrastructure, but the safety trade has quietly outperformed, and you can see that right here. Spider Gold ETF, GLD, up 21% this year to date versus the Spider Tech ETF, XLK, which is up about 15%. How about that? Here to make the case for both, I'm joined by Mark Smith, Senior Vice President and Portfolio Manager at Wells Fargo Advisors, and John Belton, Portfolio Manager of Growth Equities at Gabelli Funds. Mark, you have been bullish on GLD.
Why not? GLD is a safe haven, and if you look at it over the last 2 years, you're seeing that there are a number of reasons to go into it. Number one, geopolitical risk. We just saw yesterday 1 million barrels just got bombed in the Red Sea. That could be major issues for a number of different countries, and in fact could cause further conflict in the Middle East. And so GLD is a safe haven there. Number two, you've got a presidential election. Not one candidate is talking about our deficits, and that should be concerning for everyone. GLD is another reason why you would want to go.
Why does neither candidate talk about deficits? Because they don't care. They're only in office for a short amount of time, 4 years, 8 years. You think they care about the deficit? No, they just care about getting elected. And talking about the deficits, unfortunately, is not going to get you elected. What's going to get you elected is promising tax cuts, promising, money here, money there, help there, false promises, all those sorts of things. Now, talking deficits, unfortunately, is not going to get you elected because only a very small amount of people are even aware of the deficits. Only a small amount of people are even aware of where the federal debt levels are at and those sorts of things, right? So now what I do want to do is I want to compare GLD to Bitcoin. I'm actually interested to see how these two are performing against each other here. Because, older generation looks at gold as a place you want to be, but then the newer generation, right, the younger folks look at kind of Bitcoin where you want to be. So on a 1 year basis, Bitcoin is smashing gold, 112% for Bitcoin, and then gold's only at 29%. Now we go year to date, and we're getting a little more even here, 31% for Bitcoin and 22% for gold. We go to 6 month, and now gold's beating it, right? Gold up 23%, Bitcoin down 4%. If we go to a 3 month, wow. Gold's up about 7%, Bitcoin is down 12%, and on a 1 month basis, gold's up 5% versus Bitcoin down 14%. Now, see, a lot of the move that happened over the past year, specifically this move was obviously big money starting to really get into Bitcoin, like big money, right? Through the ETFs and all those sorts of things. And you had all that excitement and that kind of buy-in. And then since then, it's kind of floundered down, which has been disappointing considering, the market's still been, fairly risk on. Look at small caps, for instance, right? But Bitcoin's just obviously clearly having some trouble. Now, there is another issue with Bitcoin, to be honest, that I'm seeing out there. And people got to be concerned with this, okay? Trump obviously keeps talking about, if I'm elected president, Bitcoin's going to be this, it's going to be that, America's going to be the center, the capital universe, Bitcoin, blah, 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 right? Okay. The issue with that is you don't want to put any of your hopes just based upon if a president gets in. One, they might not win, right? That's a problem. Because then if they don't win, where's your price of that asset going? Down, because then all momentum's lost. Like, oh my gosh, our guy didn't win. Boom, boom, boom. The second problem is you never want to count on a president doing a lot of things because they don't do a lot of things, okay? And that goes for all of them. Like I've tracked every single president, at least in my lifetime, and they said a lot of things they were going to do, and they didn't do them. Now, those presidents would all say, it's because Congress didn't let me do it. It's because the House didn't let me do it. It's because, they'll blame it on whatever, right? But at the end of the day, presidents say they're going to do a lot. They campaign on a lot. I'm going to do this. I'm going to do that. And when it actually happens, when they're in there for those 4 years, 8 years, you find out they actually do a small amount of what they said they were going to do. And so don't always pin your hopes on a presidential candidate. I'm just telling you, it usually ends very, very bad. But, if I had to be in one, Bitcoin or gold, I would prefer to, if you forced me to put money, like let's say like $100,000, I would like to split it half and half. But if you told me I had to go one or the other, I don't know, man. I might go Bitcoin rather than gold. But I do feel like gold's a better true store of value. But I feel like Bitcoin's a much better risk on asset, right? So that's kind of my view on it.
As both of them,
and it's honestly not just my view; it's just like facts. Like Bitcoin's a risk-on asset, and gold's obviously been a great safe haven over time.
Programs would raise the deficits.
Exactly, and in that case, GLD makes sense too. And a lot of folks were going to Bitcoin, if you remember, like in the last 2-3 years. You're not really seeing that as much right now, but I think globally you're seeing a huge demand for gold, and so it makes sense from that perspective as well.
Another area you like, and I'll turn to you in just a moment, another area you like is utilities, a real safety play.
Absolutely. I mean, listen, the elusive soft landing is yet to be seen. And so utilities, you're seeing a number.
Do you think it's not coming, or do you?
we've seen it right now, but we just saw a huge job revision, right? One of the largest I've ever seen in my career. And so all the numbers that I've been seeing when I was predicting that I thought that, you know, rates wouldn't go anywhere. If you remember last time I was on, Tyler, I mean, that was based upon the numbers. The numbers are wrong. And so if you look at that, you've got to say, hey, listen, are we going to go ahead and continue this? Are the numbers going to continue to get worse because we thought they were good? Are they going to get worse than they are? And so that could be a slowdown. So maybe that's that soft landing we were predicting is wrong because we were looking at numbers that were incorrect.
All right, John, let's turn to tech. Is everything okay in AI land?
Well, I mean, thanks for having me, Tyler. I would start by saying, sorry, I have to rain on your parade and stop talking about such an exciting thing like gold and interrupt you and talk about something as boring as NVIDIA's earnings. But, I mean, I guess just to start there, because that is kind of the topic du jour, I would say it was more of a boring earnings report for NVIDIA if such a thing exists. You know, I think we kind of like boring. I think boring is actually healthy for this stock and for the longer term for the AI space more broadly. But, you know, NVIDIA is kind of a boring standard beat and raise. I think there's still plenty to get excited about. I think given all their discussion of demand, discussion of finding new customers out there, discussion of broadening the product set, there's still plenty of runway for, I'd say, accelerated computing and AI as a subset of that to run. So, yeah, I think there still is.
You own it? Would you buy more of it?
So NVIDIA is one of the top positions in each of our funds, the Gabelli Growth Fund, the Global Growth Fund, and the Growth Innovators ETF. We've owned it for many years. We're long-term investors with NVIDIA. I think a buy and hold approach has worked well for us. It's not something we tend to trade very actively on earnings reports. I'd say last night's earnings, very validating of the investment thesis. We're happy to just hold it for the long term. Think the outlook is still over time pretty positive.
Okay. So listen, point blank, that man was just asked, would you buy it? And he just gave a 1 minute explanation about all our funds, we're long-term holders. He didn't say like it's a buy, right? If you really felt like NVIDIA is a buy right now, right off the bat, you'd say, oh, absolutely, NVIDIA is a buy right now. We hold it in our funds, blah, blah, blah. We've been long-term investors. Never said it's a buy, right? Like that's interesting because it goes to show you kind of how somebody actually feels about a stock, right? Like if we looked at my biggest position in the public count is Meta, right? If you ask me, is Meta a buy right now? Absolutely. And then I could talk about, well, Meta's been a long-term holding for me. I've held it for a long time. You know, it's a huge position for me. I'm not personally looking to buy more shares right now, but is it a great deal? Yes. Here's why it's a great deal. Because have you seen the forward PE on Meta? Like if you don't have a position built, what the heck are you doing? Look at Meta's forward PE on this baby. Considering the growth rates at 25 forward PE, 2-year out forward PE 21, and look at the expected growth rates here, Meta's a steal deal. Like, you know, you can make a strong argument there, but yeah, when you don't even ever say it's a buy, that sounds like, is it actually a buy?
Sort of suspect number one not suspect, but candidate number one in AI. To your view, what are number 2, 3, and 4 where I would want to put money in artificial intelligence?
Baby.
Probably, well, I would say if NVIDIA is the top 5, is each of the first 5. After that, you know, I think there's a lot of different ways to play it. Utilities actually being one area that is going to benefit from
all the power demand.
From all the power demand.
Interesting point.
The way we're playing it, so you have the cloud service providers who are NVIDIA's largest distributors. I think being Microsoft, Google, and Amazon. And I think, you know, that's going to be the first place we see AI really tangibly show up in financials. You've also got some of these big consumer internet companies, the biggest of which, Meta and Google, where they're using AI, they're using accelerated compute infrastructure to bolster their core businesses. So that's kind of, it's not directly a play on AI, but that's an example of a business where they're harnessing this computing power and they're driving results in their core businesses. So,
okay, let's just cut him off. Yeah, he should talk about Palantir. Like people got to do some more digging, man. Sometimes I feel like these people haven't really done a lot of digging in regards to AI because, like, if the two places you go with AI are just NVIDIA and Microsoft, I'm kind of like, Like, there's other opportunities out there. Like, if that's all you got, I just don't think you got done enough digging quite yet. Next one up here. NVIDIA faces challenges as promise of AI is ahead of results.
The AI boom. Tech investor Roger McNamee joins us now. Always good to have you, Roger. I assume you've been listening to what we've been discussing at the desk. First up, what do you think of OpenAI? Do you trust Sam Altman?
Not a bit. I saw the prior segment where you were talking about NVIDIA. And to me, NVIDIA, the company, it deserves to be in whatever Hall of Fame we have for the technology industry. Because, you're talking about a company that's business is primarily hardware. They have a ton of software now, but it's primarily hardware, and they've gotten themselves to 75% gross margins on the back of generative AI and a whole bunch of other really important trends in Silicon Valley. And I like to distinguish, as you know, David, between stocks and companies. Because right now, the issue that NVIDIA faces, which I think is going to be the issue faced by everyone in generative AI, is that the promise of AI has gotten way out in front of the results. And as Deirdre just pointed out, Sam Altman would like to raise money at a $100 billion valuation off of $3 to $4 billion worth of revenue. And that may be fine. Investors may be totally comfortable with that, but somebody somewhere along the way needs to ask the question of how long do we wait for enterprise applications to show productivity and value to customers? Because at the moment, Copilot seems to have some difficulties in that regard. I think there's a big promise at companies like Salesforce that they still have to deliver. And there are a lot of questions. And from an investor point of view, I think caution is increasingly going to be the watchword here, because it doesn't matter how good the chips are at NVIDIA. If you're talking about replacing $1 trillion worth of cloud services compute over the next few years, the S&P 500, the companies are mostly run by finance people. The chances they're going to write off $1 trillion worth of capital investment just so they can buy NVIDIA's new chips, I think that may be wishful thinking.
At the same time, Roger,
So that's a good point. Yes, that's a dang good point, right? And that's where it starts to come down to who's going to see the return on investment and who's not, right? Because not everybody's going to see this return on investment. Let's keep that in mind. Some companies will. Some companies are going to get 10x the investment. So let's say they spend $50 billion on NVIDIA chips, right? Some companies are going to see a $500 billion return from that, or a $5 trillion return from that, like unbelievable amounts of money. Meta might be one of those companies, right? If Tesla ends up becoming the biggest robo-taxi company in the world, they might see a ridiculous return on investment for whatever they're spending on NVIDIA chips. There's going to be a lot of other companies that they don't see that return on investment. They don't see even remotely close to it. And so those companies are going to end up throwing away massive amounts of money, right? Not everybody's going to be a winner. Just as in the internet age, not everybody won and became the next Amazon, right? And became the next Google McDougal and those sorts of companies. So that's a little food for thought in regards to that. There's going to be a lot of money thrown away, but there's going to be a few that are going to get crazy ROIs on this.
Mentioned sort of the keywords killer app, and that's what everyone is searching for. When you look at OpenAI, it's arguably the only company that has created a killer app in the age of generative AI, and it wouldn't be possible without NVIDIA. So when you think about that, and yes, OpenAI has all of these well-capitalized, huge mega cap competitors, do you think that in a world where there's only a few players, OpenAI could be one of them?
Well, Deirdre, you made the point earlier, though, that this may be a killer app. The amount of revenue associated with it isn't in killer terrain. It's in the really compelling, but wow. $150 billion or so has been invested in the infrastructure required to support these AI apps, and the total revenues are what? A tiny fraction of that. And
right, but Roger,
to push, let me hear if she pushes back the way I'd like to push back.
How it goes. You know the Gartner cycle, right? The trough of disillusionment, and then it starts to pick up. That's what everyone I talk to is waiting for. They say
yes, exactly. It's no different than Facebook back in the day. People poured a lot of money into Facebook, and was Facebook making a bunch of money? No. But then it obviously did over time, right? And Google, and you could look at all these different companies.
A little more time here.
But Deirdre, let's remember, we've been watching this for a long time. Historically, the numbers were at most a tenth as big as what we're seeing in this category. So the risk we're taking is much, much greater. So time is going to matter. If you're wrong by a year investors are going to be very unhappy about that. And
Although
so,
unlike the 90s, which you and I well remember, and all the capital that went to all the companies that went out of business, I mean, here we've got this capital being expended by the largest companies. They're not going out of business, not even coming close. They can do this, and if you're right, they can still kind of move on.
I have no doubt that that's true, David, but they have enormous stock market valuations that are at risk. So, I don't think the solvency of Microsoft or Google or Amazon or Apple is in doubt here. But there's no question that when you're spending whatever Microsoft's spending a month, roughly $10 billion, I think the number is, investors are entitled to have expectations for a rate of return on that that's commensurate with the risk that they're taking. And that it may be there, but that's the risk you're taking today, because the evidence is not yet overwhelming that they've solved the productivity problem in enterprises. In fact, the evidence is that they're not close. And if that's true, and you have to wait another couple of years, people might legitimately get impatient.
So important points he brings up there, and those are fair points, right? But at the end of the day, this is a process we have to go through. And when it's all said and done, I think most of the spend will be justified, because most of the spend is going to come from the biggest big dogs, and I think they'll get a good ROI on all the spend they're doing right now, right? But that question he brings up, like, are we actually going to get the ROI from this? I think that's a fair question. I think that's what could end up hurting NVIDIA's numbers, really kind of like 2026, 2027-ish, because I think you're going to stack up some of these worries next year in a major, major way. I think a lot of people will start talking about, wait, are we really getting this ROI on this? And then you could actually see some of the big dogs start to pull back on some of their insane spending. And it doesn't take a lot of pullback, right? The problem is NVIDIA has to hit bigger numbers. So 2026 has to be even way bigger numbers than 2025, let's say, for instance. So what if companies just flatline their revenue, flatline their spend with NVIDIA in 2026? What if they don't up it? They just keep it the same? Well, suddenly, next thing you know, NVIDIA has an insane revenue problem overnight, right? So NVIDIA is really counting on Meta, Microsoft, Tesla, all these companies to spend exponentially more in 2026 than they do in 2025, and spend exponentially more in 2025 than they do in 2024. I'm fairly confident these companies are going to spend more in 2025 than 2024, but it's not going to be like a crazy number more. It might be 10 to 20% more. Am I confident they're going to do that again in 26? And that's where I start to have question marks, right? That might be just kind of like flatlining their spend there. So fair points he brings up, but we'll see. Warning signs emerge after NVIDIA's earnings report.
But the street was perhaps looking for a little bit more. Seema Modi's been following the price action in the stock this morning. Seema, break it down for us.
Well, Wilfred, a strong report overall, but if you were to pick out some concerning signs, one is the size of NVIDIA's earnings beats, which are coming down 6% in the second quarter compared to the 29% back in 2023. The revenue beat also narrowing over the past few quarters, something that analysts have been talking about. Now, on the earnings call last night, NVIDIA did acknowledge that operating expenses are going up as its next generation graphics processing unit Blackwell ships out in the fourth quarter. Its biggest business, data center, saw record growth, 45% tied to cloud service providers. Gaming sales were up 16% year over year, quieting concerns about heightened competition. And there's an active debate amongst Wall Street folks about gross margins. Bernstein's Stacey Rascon writing that the one smudge on this report was end of the year gross margin outlook. The 75.7% in the second quarter was a quarter-on-quarter decline. On the earnings call, NVIDIA CEO really stuck to his big picture message, saying if you just look at the world's cloud service providers, the amount of GPU capacity they have available is basically none, because they're either being deployed internally for accelerating their own workloads and data processing. So no demand issue here, guys. In fact, Huang added that supply is improving going into 2025. Deirdre.
So obviously last night on the main channel, I did a very in-depth, if you don't follow me on the main channel, Financial Education, did a very in-depth video on NVIDIA, right? And there's a problem NVIDIA stock has right now. Not the company has, but the stock has. And that is, in order to be a great stock, what makes a great stock great for a 1-2 year run is you have accelerating revenue growth, you have accelerating earnings per share growth, and you have accelerating margins, right? NVIDIA has the opposite of all those three now. They have decelerating revenue, decelerating earnings per share, and they have decelerating margins. So they have the trifecta going the wrong way now. And that's why NVIDIA stock's having trouble going up now at this point in time. Because people are looking and they're like, all the things you want to see, you're not seeing now at this point in time. Which means to get stock gains, it's just, you can still get them, it's just a lot more difficult of a process. It's so much easier when you got that accelerating revenue, accelerating earnings per share, and accelerating margins, right? And that's what NVIDIA really had for, a year and a half straight. All those things were accelerating, and now they've all went the other way, right? And so you're seeing NVIDIA still grow revenues very nice, earnings per share very nice. You're still seeing great margins for the company, and yet people aren't willing to buy the stock. Well, it's because it trades at a richer valuation, and you have the opposite of the trifecta, right? NVIDIA trades at, a 70 trailing 12-month PE, a 48 forward PE. Even if you look at a 2-year out forward PE, 33 roughly, right, based upon analyst estimates here. So that's the issue you have going for NVIDIA stock right now. But outside of that, market obviously pretty dang bullish here today. Appreciate y'all joining me as always. Thank you so much for being here. If you're looking to access 1000xstocks.com, as well as my private stock group, private wealth group, pin comment down there, click on that, fill out an application. We'll see if we can get you access to all that, become a much better investor, see if we can get you access maybe next week. Much love and have a great day.